I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, November 29th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Let's see, currently we have futures up a little bit. Dow futures just turned a little red. They are -2. S&P futures up 7.5. NASDAQ futures doing best of all this morning, up about 40. And this is still with about an hour and 45 minutes to go before the market opens. Crude oil prices up $1.50. That's almost 2%, back near $79 a barrel. And the 10-year Treasury yield down about 4 basis points to 3.66%. So that's how we're going to start off the day. We had a really rough day on Monday. We're going to get into that in just a bit. Let's go ahead and go through today's agenda. So I'm going to start off with the daily market recap, then talking technically. I'm going to break down the communication services sector. This has been one of the worst sectors. Just looking to see if maybe there's any hope out there, some improving areas, maybe some stocks within those industry groups that might be showing some leadership. We'll try and take a look at all that. Then earnings spotlight, and we'll wrap the show up with the 3 you must see, taking a look at 3 Dow components. Before we get into any of that, though, and get the show started, let me take you over to earningsbeats.com, where if you go over a couple things I want to point out. First of all, our fall special, which technically ended yesterday, had a lot of folks traveling, so we decided to extend it 2 more days. So you've got until today at midnight. That was, like I said, it was supposed to end over the weekend, but we did give it 2 more days. It's our best deal of the year. We want to make sure anyone who is interested takes advantage. If you go to our website at earningsbeats.com, you'll see that link right there on the middle of the page. You can click on that to get more information, but we have extended it through today, midnight. Also, if you are new to Earnings Beats and you just want to find out a little bit more about us and how we look at the market, I would highly recommend that you subscribe to our free Earnings Beats Digest newsletter. This is a newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays. Very quick read, just a couple paragraphs and a chart, but it is designed to be very educational. I think it'll help in maybe the way you strategize, the way you approach the stock market. All this newsletter takes is a name and an email address. Hit that subscribe button. No credit card required. You can unsubscribe at any time. We would absolutely love to have you. We do a lot of free events, and I'm starting to announce now Market Vision 2023, Saturday, January 7th. So if you've been part of our last 3 Market Vision events, you know that made some pretty bold calls and some pretty good calls. And I'm going to have some bold calls coming up again on Saturday, January 7th. This is a free event, a free event. All you need to do is be a part of our Earnings Beats Digest newsletter. So remember, go in, sign up. It is free, no credit card required. Love to have you. And there'll be a lot more coming out over the next several weeks on Market Vision 2023, including who will be joining me. And that will be exciting news as well, and that'll be out later this month. Or I should say later next month in December. Okay, let's go ahead and jump into what happened on Monday. So let's get into the daily market recap. First of all, Dow Jones Industrial Average down 500 points, 497.57. S&P down 62. NASDAQ down 177. All of them down roughly 1.5%. Mid caps and small caps both hit a little bit harder, near 2%. Looking at the individual sectors, the consumer stocks actually held up best. Staples and discretionary were the 2 best. All 11 sectors, though, were down. These were the 2 that held up the best on a relative basis. Staples losing just under 0.4%. Discretionary losing about 0.6%. And then you had healthcare losing about 0.75%. The 2 worst groups were real estate and energy. Real estate down almost 3%. Energy down 2.75%. I just think energy is running into some problems here with the negative divergence. So we've got PPO that's been rolling over as prices were trying to go higher. We lost that 20-day moving average. It certainly appears that we want to head down and hit that 50-day moving average. Sometimes, though, when you get these negative divergences, you just go into sideways consolidation mode. And instead of moving lower to test the 50-day, sometimes the 50-day just comes up to test price action. And so hard to say which way it goes here. Right now, we do seem to be more in consolidation mode. I just wouldn't be overly concerned if we were to drop on energy down to about 84, 85, just because that's typically what happens when we get these negative divergences. We get a 50-day test, and a lot of times we'll get that center line test or reset. So overall, market action not good at all on Monday. It is a Monday, though, or it was a Monday. And as I pointed out in our daily market report to members yesterday, Mondays since 1950 have been awful. Awful. Annualized return of all Mondays since 1950, right around 14% negative, minus 14% returns, annualized returns going back 72 years. And you might think, well, it's just one day of the week. Well, it's one day of the week for 72 years. It's basically 1/5 of all calendar days. Pretty significant. Anyway, we got another week started off with a rough Monday. I try not to get too aggressive from a trading perspective until we get past Mondays, just because of that historical fact. Once you get into Tuesday and then later into the week, historically, the odds, not the guarantee, but the odds are that you'll do much better trading. So keep that in mind, not just this week, but most weeks. I mean, it's just you want to be careful on Mondays. All right, let's keep moving here. Got the 10-year Treasury yield. Currently, well, it's not showing on this chart just yet, but as I mentioned, right now we're down 3 basis points, 3.67%. You can see the 10-year Treasury yield since that big drop, which coincided with the October CPI report coming out. That's when we had that massive decline. Since then, we have continued our trek to the downside on the 10-year Treasury yield. Will it continue? I don't know. I mean, I think based on the time of the year, I know a lot of the conditions that were very bearish and cautious looking back at the beginning of the year, many of those conditions are now gone. So I think the market has a much, much better chance to rally now than we did earlier in the year. And I do suspect that we are going back to all-time highs. I believe it's going to take place in the first quarter of 2023. We'll see. Things can change. We got more inflation reports coming up. We've got the Fed meeting. Fed meeting is on December 13th and 14th. So that's coming up in just 2 weeks, starts 2 weeks from today. So there are a lot of things we have to keep an eye on. But a lot of things have changed. A lot of the environment has changed now versus where we were just about 11 months ago. All right. Actually, we do have a couple of economic reports out today. So let me give you those. Later this morning, we will get the Case-Shiller Home Price Index out and also the FHFA House Price Index. So both of those in the housing area will be out later this morning. Also, later this morning, we'll get the consumer confidence. And then Wednesday, ADP employment report. Also, the Q3 GDP second estimate will be out on Wednesday. We're just expecting for a little tick up from 2.6% to 2.7%, so nothing major there. Thursday, of course, initial jobless claims, and Friday, non-farm payrolls. So we do have a lot coming up for the market to digest, for the Fed to take a look at, and we'll see how the market reacts to all this news. It's not so much the news, it's the reaction to the news that I'm most interested in. But right now, as we head into these key economic reports, you can see that we've got folks that have been moving into bonds again. This is not the longest stretch of bullishness in bonds. And remember, when yields are going down, that means bond prices are going up. So that's why I'm talking about bullishness. Normally, you see the chart going down, you don't think bullishness, you think bearishness. But remember, yields are inversely correlated 100% to bond prices. So this is a bullish move for bond prices going higher while the yield drops. But anyway, this bullish period that we've been in for bonds, still shorter than what we saw back in June through early August. I mean, that was about 7 weeks. Right now, we've gone about 5. So we got a little bit more room. But outside of that period this summer, I mean, this is probably the most lengthy bullish period in bonds that we've seen in 2022. We are trending now below the 20-day. The 20 is crossed below the 50. The PPO is now negative and pointing straight down, continues to move lower and lower every day. So this configuration is showing that we are in a downtrend in yields and an uptrend in Treasury prices. That I would expect to be very bullish for U.S. equities if it continues. Now, right now, the stock market has struggled a little bit. Let's take a look at that, move into the daily market recap here, or excuse me, into talking technically. S&P 500, you can see we've struggled to get to continue moving higher. Again, let's take a look at that 10-year Treasury yield. Treasury yield has continued moving lower. The S&P is struggling to move higher and pulled back yesterday pretty significantly. But we are still above the 20, which is above the 50. The PPO remains bullish. I don't see anything bad here. We pulled back, but we're still well above the 20-day. NASDAQ, things are getting a little bit dicier. We're a little closer to the 20-day. We're a little bit closer to that recent price support area. If we look at the price support right here, that open was 11,521. Here, we got down as low as 11,503. We finished yesterday 11,587, so we don't have a whole lot of room to the downside. The 20 days 11,530. So we're only about 0.5% on the NASDAQ 100 from testing that 20-day. And if you're clinging to the thought that, hey, we're in an uptrend, we need to hold the rising 20-day moving average, and I do think that's a key piece here short term, technically. If we need to hold that 20-day, we don't have a whole lot of room to the downside to do it. So futures look good right now, but if we do turn red this morning, watch that area. I'm going to say right from about 11.5 to 11.530. If we have a big move down beneath that level, then it looks like gap support. And this was from that October CPI number that came out on November 10th. But we opened that day at 11,350 and really didn't look back. So that is going to be a really big level. Look at the 50-day moving average, 11,339. So all of this is coming together pretty close on the NASDAQ 100. And this is a group that I would expect to perform well if rates continue to drop. This is a group that underperformed while rates were rising. It makes sense that we would outperform while rates are declining. So far, that really hasn't been the case. I mean, since we got to, right around that November 10th and November 11th timeframe, if I pull up a NASDAQ chart relative to the S&P 500, and let's put this on a line chart. I don't really care about any of this other stuff. I mean, you can see here was that move up. So we continued to show relative strength on the NASDAQ until November 15th. And then we've started declining again. Well, if you look at that 10-year Treasury yield, November 15th right there, we've continued to go lower in the yield. So the fact the yield keeps dropping and the NASDAQ is losing relative strength, that's, I thought maybe, okay, at the very beginning when this was happening, I was thinking, well, we had options expiring. That makes sense. We had a little bit more, we got a little carryover just past options expiration sometimes. I can kind of see that. But the rest of last week was not good. We continued meandering lower. You might say, well, yeah, but it was lighter volume on Friday and Wednesday was travel day before the holiday. I mean, we can keep going down that rat hole and making excuses. But the bottom line is if yields keep dropping, this ratio should start to move higher. It did on that initial big drop in the 10-year Treasury yield right here. On that big drop, you can see the relative strength, and that's what I would expect to continue. Last 2 weeks, not so much, though. That needs to turn. All right, let's move on to break it down. So I want to look at communication services today. And the first thing I want to do is, most of the key areas of the market, we've seen movement to the upside. And here was the October CPI report released. Communication services looked horrible. And all of a sudden, a few days after the release, we were back up above the 20-day. We went through the 50-day. The PPO is crossed and turned into bullish territory, positive territory. The 20-day just crossed above the 50. We got that bullish cross, but we're hanging right down near the recent lows, also right on these moving averages. Again, with rates falling, this should be a group that's showing relative strength, and we're just not seeing it. And I look at the AD line, and while many of the other areas of the market, the AD lines look pretty strong, there doesn't seem to be a lot of accumulation taking place here in the XLC. I mean, if there's one positive about the downtrend recently, is that at least this sideways action has held the 20-day, number one, and the 50-day. And number two, it's kind of been through the holidays. We've had lighter volume, so maybe you can make that argument, but that argument's not going to last. Again, yesterday was not a good day. Volume started to pick back up again. We need to see this group turn, and it needs to turn now. So, question, is there anything here on the absolute chart that really makes us believe that things have turned? Well, the only thing that I really see is, the positive divergence here back in early October, but that really has already played out in my mind. We went up, we tested the 50-day moving average, and then we went to a new low. That's not good behavior. Usually what you want to see is after a positive divergence, testing the 50-day and then pulling back to maybe test the rising 20-day is okay. And then you want to see a movement that shows, hey, this selling is over. We're breaking out to the upside. Didn't really get that. Went down to a new low instead. Now we have come back with that CPI report, and we have been trending a little bit above the 20, which is now crossed above the 50. We've seen this before. We saw this right here. Broke above the 20 and the 50. The 20 crossed above the 50. And then look what happened. We failed to hold the 20, and it just kept going down. Look back to the end of March, same thing. Moved up above the 20 and the 50. The 20 goes above the 50 slightly. Here, positive PPO. All three of these look almost identical. Well, the first two, you can see once we lost the 20-day, it was over. Once we lost this 20-day, it was over. So this is a critical test. We're at 49.40 on the XLC. The 20 days, 49.25. This is an area where we need to see the bulls step up. Communication services, this houses broadcasting and entertainment, stocks like Disney. It houses internet stocks like Alphabet or Google, Pinterest, these types of stocks. We need to see, these are growth stocks, and probably the worst performing area within growth stocks. Can this group, this is going to be the group that gets the first test, and I think it's coming today. Do we hold? Can we begin to show some strength? Can we break out above these recent highs? I would have liked it if the price action right here, if we could have just gotten up here to maybe put in a slightly higher high than that October high, but we fell short. So even because what I would like to have seen is maybe a slight upsloping right side of the neckline for a possible bottoming head and shoulder pattern. Didn't see it. We fell short. So now we have the down sloping neckline, which I don't like, not nearly as much. I want to see a move back to the upside that's showing an upsloping neckline. Now, maybe we're going to get it. Again, we haven't broken back down, but it's just, this is one of the areas of the market that I would say they're just not really showing a robust move off the recent low. Not enough to really get me excited that the bottom is in on this group. And if the bottom's not in on this group, it's going to be hard to argue that the bottom is in on the market, because it is one of the three aggressive groups that I like to follow. I like to follow technology, consumer discretionary, and communication services. I follow them all 11 sectors, but these are the three in secular bull markets that lead the market to the upside. So when you start thinking about the resumption of a secular bull market, you want to see leadership from these three areas. Not really seeing it just yet. So the XLC on a relative basis, this is what we've been dealing with right here. So here's the absolute chart. And you can see the XLC from the bottom of the pandemic in March of 2020, we ran from about 39 to 85 in 18 months. That's a massive move. But over the last 15 months or so, we've given it almost all back. Now, here was a big low back in the trade war. We held that with the pandemic. So far, we're holding that with this low. So we still have an uptrend. And you certainly could argue that, well, the reason we came down so hard is because we went up so fast to begin with. Rates came down to near zero. This group took off. Now rates have moved back, above 4. We got up on the 10-year treasury yield to what, 4.30, maybe a little higher. And that took a toll on this particular area. So we're looking for relative strength. Now, as we kept moving lower here, have we put in a relative positive divergence? Could this be a sign? I don't know. I mean, on a relative basis, communication services has given back almost all the gains since back in April of 2013. And that's where we made the big breakout, right about there. Now, when I say the big breakout, the S&P 500 on April 10th, 2013 closed above the 2000 high and the 2007 high on the S&P 500. That double top was cleared on April 10th. That's why I always look to April 10th as a significant level, because that's when the market finally confirmed a big breakout and never really looked back. Communication services now is flat since that time to where we just hit this recent low. We've given back a ton. This has been such a weak area. And I'm sure valuations have gotten very, very cheap in many of the stocks. But if you're a momentum investor, it's hard to jump in regardless of the valuation when you see this continue and when you see the absolute weakness continue. We want to see the start of what appears to be an uptrend. And I just don't know if we're there yet. So this is part of the problem I have with this group for now. So what's going on with the internet group? So here's the internet versus the S&P 500. And you can see just a huge decline. October, crazy decline. Started to bounce. Was that the washout? Was this the final decline? We actually went down on the internet stock, or excuse me, this is internet here. This is broadcasting and entertainment down here. I don't know why that changed. That should be NS. Take a look. Let's make this change and then take a quick look. Here we go. Okay. So internet stocks have held on to the low established back in March. And also that low that we saw all the way back in October in the fourth quarter of the trade war in 2018. So that quick little bear market there. This bear market held this low, and now the current bear market, we're still holding the lows. So maybe, I don't know. Again, I'm grasping for straws here because the group's been so weak. But I guess, if we take a look and we say, well, pretty close to a trend line test here, aren't we? I mean, that right there is pretty close. So maybe, just maybe, the internet, which I believe is the most important part of the communication services sector, maybe we've hit a support and we bounce from here. But if that's the case, then we go back to the XLC on this chart I was showing you. We shouldn't see this going back down to 45. If we do, we're likely breaking back down on the internet group. So this is something maybe just to keep an eye on. See if the internet stocks can begin to regain strength. By the way, internet stocks do extremely well in January. Let's pull that up real quick. I'm pretty sure it's January for the last 5 years. But if we go back 10 years, 3.6% average return And if we compare internet to the S&P 500 and go back 10 years, you can see 9 out of 10 years, internet has outperformed the S&P 500 since 2013. We're a month away from their strongest month. So if they can begin to repair their charts a little bit, then I think we're looking at maybe a pretty nice January ahead. But we got work to do, no doubt. All right. Let me go back here. And let's take a look at that broadcasting group for a minute. Because here's that relative weakness on broadcasting. This is a 10-year chart, by the way. And you can see the relative weakness began back really at the peak of the pandemic, or excuse me, a year after the peak of the pandemic. So we had one solid year where we went up, and then 1.5 years where we've given it all back on the absolute chart. And on the relative chart, we're way below where we were. So broadcasting and entertainment has just been incredibly weak. Still not returning. So if you're waiting for Disney, you might have to wait a little bit longer. Anyhow, those are the two key areas within this communication services group, and the two I would be watching the closest. Within our strong earnings chart list, one thing you can do is type in communication services and sort it in scooter order. Now you can see there aren't many stocks from this group because the group's been so weak. Why has it been weak? It hasn't really had very good earnings. So not many stocks are going to make our list. Well, here are some of the ones to keep an eye on. Netflix, Interpublic Group, IPG, OMC, Bandwidth, BEKE, they report, I think, this week. Pinterest. Those are the only 6 stocks on our strong earnings chart list from communication services that also has a scooter score above 50. Something to at least think about. All right, real quick, going to take a look at the earnings spotlight. One of the bigger stocks coming out with earnings today is Intuit. And so I just thought I'd pull this one up. Actually, I think this is just today or tomorrow. Yeah, I think this one's today. But I believe they report after the bell today. Here is your downtrend in their AD line. Here's the downtrend in price action. Intel was starting to show strength versus software, but in the last month or so during this quiet period, it's lost some strength, and you can see the volume has picked up on some of the selling. I don't know, software has been so weak relative to the S&P 500. I just don't have many positive thoughts when it comes to stocks like Intuit. So just be careful with this stock, and be careful, of course, always heading into earnings. All right, the 3 you must see real quick. Amgen. I think Amgen, the AD line looks good. Price action looks good. Nice bull flag, by the way. Relative strength has been strong. I really like Amgen here. Cisco's been on the improve since its earnings. Here you can see the move up with its earnings report. AD line still not great, but relative strength you can see at about a 6-7 month run relative high. Looks good there. And then the last one I have for you is Nike. Again, AD line not good, but price action starting to turn up at least. Relative strength, not great. So this one, I think of the 3, I really like Amgen the best. Cisco improving a little bit, and then Nike not so much. Those are just 3 of the Dow's 30 components. Anyhow, that's it for me. Listen, have a great day today. I'll be back tomorrow over at earningsbeats.com for your next Trading Places Live. And don't forget, if you're interested, our last day of the fall special. We extended it 2 days. It ends tonight at midnight. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.